So if you're preparing for Caiib exam, then do watch this video till end, because in this particular video we are going to cover the very important topics, and further this video is going to be very important for you for the upcoming exam of Caiib. So whether you are going to prepare in Hindi mixed English language or you're preparing in English language, both the courses are available with the learning sessions over there, which you can basically be enrolling, signing up at our website, that is mentioned on the screen over there and also present in the description box below. Or you can simply scan the QR code over here and further can navigate to the website over there, or you can alternatively download our Android application, which is available in the name of IIBF Learning Center. And if you are iOS user, do download My Institute application and use the organization code GEGKT and start preparing for the same. We are having the full course for Caiib, in which we will be covering all the 5 papers of the Caiib, including the 5 elective subjects over there. And further, those are available in Hindi mixed English language. The electives are available only in bilingual language and not available in English language. But in English language, we are having the full-fledged 4 compulsory subjects, and we are covering the full course videos which are covered in chapter-wise manner. We are having the full course case study videos, and we are having the chapter-wise previous questions, mock test, mega mock test, each and everything is there. And also we are going to provide you with the complimentary access to the ePDF notes, so as that you can escalate your revision throughout the time when you will be preparing for the Caiib over there. So do enroll right now and start preparing for the same, and don't forget to watch this video till end. And further, if you like this video, do like this video and share this video among your friends and colleagues who have been preparing for Caiib. So case study 1 over here is listed, which says it is related to the volatility and risk, and it says bank ABC is engaged in 3 business lines, namely lending, investments and remittances. So there are 3 business lines for bank ABC, and further the information related to the operating profits for these 3 business lines is given as under. So it is given as under. So these are basically the business lines, that is lending, investment and remittance, and against them the operating profits are given for the different years 2018, 2019 and 2020. Okay, so based upon the above, we need to calculate the mean, and also we need to find out that which of the business line is the most volatile and which of the following is the least volatile, and further which is having the highest risk associated with it. Okay, so that can be done if we will be calculating the volatility. So I told you that volatility is related to what? Volatility is the dispersion of the variable around the mean value. Dispersion of the variable around the mean value, that is the standard deviation that we need to calculate. So in this particular question also we will be doing the same, that we will be solving the standard deviation. So what is volatility actually? It is the standard deviation itself. If you remember from the previous lecture itself, that is the volatility is equal to standard deviation, and standard deviation is equal to the under root of square root of the variance. That is the formula related to it. That is the formula related to it. Is it clear? And now you can calculate the variance too. You need to basically, for each and every term, you will be subtracting it, you will be subtracting the mean value from it. So it will be x1 minus mu. Let us take the mu as the mean, and square of it, then x2 minus mu and square root and so on, divided by the number of terms n, and that would be basically related to the variance that we need to calculate. So first of all, we will be calculating the mean value over here. We will be calculating the mean value over here. So we are provided with the means, we are provided with what? We are provided with the means over here. We are provided with the different operating profits over the years for the different 3 business lines over there. So we will be calculating the mean value over here first of all. Okay, so now we are provided with the data in a horizontal format. So we will be calculating the mean as such. Okay, so it will be 200 plus 310 plus 190, that is equal to 700. So it will be 700 divided by 3. So mean for this term would be equal to 700 divided by 3, and for this particular part it would be equal to 150 plus 160. So for L, let us say for lending, it is basically equal to what? It is equal to 700 divided by 3, and further for investment it is 150 plus 160 plus 230, and further it is a 540 divided by 3. And in the case of remittance, it is 50 plus 55 plus 65, that comes out to be 170 divided by 3. So that is the mean value related to it that we have calculated so far. So it is 170 divided by 3, that comes out to be 55.66. It is 170 divided by 3, so it is 56.66. And further for 540 divided by 3, so it will be 540 divided by 3, that is equal to the 180. And further for 700 divided by 3, it will be equal to the 233.33. So that is a mean value over here. That is a mean value we are having right now. And further we need to solve the further. We need to solve the further. Relatively we will be calculating the standard deviation, and for that we need to calculate the variance first of all. Okay, so I'll be solving one part for you and you will be solving the others too. So let us take the case over here that L over here, for L over here, it will be equal to 200 minus 233.33. So that will be equal to 33.33 minus 33.33, because it is 200 minus 233.33. So square of that, plus it will be 310 minus 233.33. It will be 310 minus 233.33, that is equal to 76.67 square. And further the third term, it would be equal to 190 minus 233.33, that is equal to 43.33, that is minus 43.33, and square of that, and divided by n. So it will be 33.33 multiplied by 33.33, that is equal to 1100 plus 76.67 multiplied by 76.67, that is equal to 5878.28 plus 43.33 multiplied by 43.33, that comes out to be 1877.4 divided by 3. So we will be adding them up. So it will be 1877.48 plus 5878.28 plus 1110, and further divided by 3. So there it comes out to be, the variance comes out to be 2955. So the variance over here we calculated in this particular part, it is 2955, and the under root of that. So in first case we are getting the standard deviation to be 54.36. We are getting the standard deviation. I'm writing it over here because there is some issue related to the reflection, so I'm writing it over here. So it is 54.36 in this particular case. It is 54.36 in this particular case, and now we need to calculate it in the same manner for the other two. So it will be, for the second case, it will be 180 is the mean over there. So it will be 150 minus 180, that is equal to minus 30 square, plus 180 minus 160 minus 180, that will be minus 20 square, and further 230 minus 180, that will be 50 square, and divided by 3. So that will be the mean. So 30 into 30, that is equal to 900 plus 400 plus 2500, that is 3800 divided by 3, that comes a variance. So the variance in this particular case, it is 1266.68, so the square root of that, and in this particular case the variance comes the standard deviation comes out to be 35.59. Okay, we need to calculate it for the third one now, where the first part, it would be 50 minus 56.66, so it will be minus 6.66 square, plus it will be 55 minus 56.66, so it will be 1.66 square, plus it would be 65 minus 56.66, that is equal to 8.34 square, and divided by 3. So 8.34 into 8.34, it comes out to be 69.55 plus 1.66 multiplied by 1.66, it is 2. I know the calculations are quite lengthier over in this case, but you need to do so because you are to basically solve it. Only in that case you'll be getting the marks over there now. So it will be 44.35 divided by 3. So just adding them up. So 44.355 plus 2.75 plus 69.55, that comes out to be 116.65 divided by 3, that comes out to be 38.88. so that comes out with a variance in this particular case. And further the under root of this would be 6.2. It would be 6.235. so kindly please let me know if you have got these answers or not. So kindly please do answer if you are getting these answers or not, or is there any variation in this particular part. Okay, so the standard deviation now we have calculated. Now if you remember when we basically calculated when we were to compare the different lines, what we did actually, what we did actually, we divided it by the mean. So we basically calculated what? We calculated the standard deviation divided by the mean. We did what? We calculated the standard deviation divided by the mean. So that is what we'll be doing in this particular case. That is what we will be doing in this particular case. So it will be, we will be calculating now standard deviation divided by the mean value. Okay, so now this particular point itself, that is the standard deviation, is the volatility. Now you can let me know, which of the following is having the highest volatility, and further which of the following is having the lowest volatility, because it is quite clear now. In the case of the lending, the standard deviation is much higher than the other two. So we can say that in the case of the dispersion, in the case of the lending, the dispersion is much more volatility, that is the variation is much higher as compared to the investment and remittance. Okay, so we can say this is most volatile. And we can also infer the same related to, because the standard deviation in the third one, that is related to the remittance, it is the lowest. So we can say it is the least volatile. So high volatility means higher risk. So we can say in the case of the lending, we are having the highest risk associated with it. Okay, so we can simply infer now. So you need not to calculate the standard deviation divided mean actually. Okay, so that is how we can solve the questions based upon this. Okay, so it will not be covered in one single question. It will be covered in 3 different questions, like which of the following is having the highest volatility, which of the following is having the least volatility, and further which business line is having the highest risk associated with it. Okay, so we basically need to answer accordingly over there. Is that clear? Okay, so that is related to this particular case study. Now let us solve the another one, which is based upon the value at risk. So value at risk is basically type of criteria that we can calculate. So value at risk is a methodology by which we can calculate the downside potential, if you remember. So in the case of volatility, we basically do have the upside potential and also the downside potential. We are having the upside potential and also the downside potential, but because we are to quantify the risks only, so we will not be looking at the upside potential. We will be basically focusing on the downside potential only. So we can basically calculate the uncertainty, but the probability that of the occurrence is to be calculated, and further that can be done by using the Z table values. So I'll be just letting you know that how we basically use the value at risk, how we basically calculate the value at risk. Okay, so now let us have a look at the case study that is related to the value at risk. So based on the previous 60 days trading data, the following information is available. That is, volatility per day is given to be 2%, and it is assuming 252 days in an year. And for the number of observation days is 10, and for the confidence level is 99%. Investment amount is 60,000. And further we need to calculate the VAR, that is value at risk, for 10 days and 30 days period. So if you remember that, what does the volatility means? Volatility is basically equal to the standard deviation. So we can say the volatility is basically what? It is the standard deviation. And further, when we say standard deviation per day, it is given to be 2%. So 2% of what? 2% of the invested amount. 2% of the invested amount, which is rupees 60,000. So the investment amount is rupees 60,000. Okay, so what would be the volatility? 2% of the 60,000, that is equal to 1200, if I'm not wrong. It is equal to 1200. So it means what? It means there is a dispersion of around 1200. There is dispersion of around 1200 around the mean value. That is basically related to volatility of the single day. Okay, and further also, when we were to calculate the volatility over the different time horizon, that was also possible. If you remember that we have the formula related to that is related to volatility, that is a standard deviation over a time horizon. Volatility, the formula was volatility over a time horizon. Okay, that will be equal to what? That will be equal to the daily volatility that we calculated above, that is equal to 1200, and multiplied by the square root of the time horizon, for which we need to calculate the volatility itself. Okay, so here we need to calculate the volatility first of all for the 10 days period. for the 10 days period. So it will be daily volatility, we calculated it to be 1200, that is 2% of 60,000, that is the invested amount, multiplied by the under root of 10. So here we can calculate the volatility for the 10-day period, that will be equal to 10 under root multiplied by 1200, and it comes out to be 3794. It comes out to be 3794.73. Okay, so that is related to what? That you calculated the volatility. But in the case of VAR, if you remember, there are two factors. First of all, we need to calculate the uncertainty. So we calculated the uncertainty amount. Okay, and second factor, it was related to probability of occurrence. Which we can predict by using the Z table, So we will be looking at the different values of the Z table, because the confidence level over here is given to be 99%. What does it mean? If we say the confidence level is 99%, it means for the 99% of the times there will be basically no events of risk. And for the only for the 1% of the time there will be event of risk. And for that particular purpose, we predict the value, and further we get the value at the risk which is available over there, which will be basically affected over there. So that is a case related to that. Okay, so in this particular case, we are considering the confidence level to be 99%. For this confidence level of 99%, we will be looking at the Z table value. So let us have a look at the Z table value over here. So we are having the Z table, and in the case of the exams, you need to memorize some of the common used Z table values, that is 99.99%, that is 90%, 95.5%. So these are commonly asked values in the questions itself. Okay, so over here we need to get the 99% value. So just look at the 0.99 value only. So over here it goes to 0.91, then 93, 94, 95, 96, 98, 93. So we will be just moving on in this line particularly. So it comes out to be 0.9901 in this particular case. So it means it is having the probability of 99% over here in this value. So it comes out to be 2.3. So it is 2.3, and further we will be looking at this is the fourth line over here. So we will be looking at this particular line over here. So it comes out to be 0.03. So it will be 2.33 value. So the Z table for the 99% of the value, the Z table value is 2.33. It is 2.33. So if we now need to calculate the VAR, how we can calculate it? We simply need to multiply the volatility over the time horizon with the Z table value. So it is basically 3794 minus 0.73 multiplied by 2.33. So it gives us the value equal to 8841.72. So this is the value that would be at risk. If we basically considering it for the confidence level of 99%. If we considering it for a confidence level of 99% for the 10 day of the horizon value, 10 days of the horizon value. Is that clear? That is how we basically calculate the value at risk. So that is how we calculated it for the 10 days. Now you need to calculate it for 30 days also. So there is an exercise for you. So how we can calculate it? We can calculate it in the same manner. So the standard deviation for 30 days over time horizon, it will be equal to daily volatility, that is equal to 2% of 60,000, that is 1200, and multiplied by under root of 30. So 30 under root multiplied by 1200. So it comes out to be 6572. So it comes out to be 6572.67. So this is the volatility value. Okay, and further we need to calculate it for the 99% confidence. We already basically looked at the Z table where we just have the value equal to 2.33. So the Z table value is equal to 2.33 for the 99% confidence level. So over here we will be multiplying 6572.67 multiplied by 2.33 for 99% confidence level. So it will be basically equal to what? It will be equal to 2.33, so it comes out to be 15314.32. Okay, so it means what? It means, it indicates what? It indicates that the value at the risk at any time will be maximally equal to 15,314 over the time horizon period of 30 days if the confidence level is 99%, and it will be that only 1% chances are there, only 1% chances are there that the value at risk may exceed this particular value, that the value at risk may exceed this particular value, that is 15,314. Otherwise your risk will be contained to the limits of 15,314 only in 99% of the cases. Is that clear? So that is the value at risk. So that is related to the value at risk. I hope that you must have understood this concept as well. So that was related to the downside potential. So now we'll be considering the second unit related to it. So in the examination, you will not be provided with the Z table itself. You need to memorize the Z table values for some of the cases, likewise for 99% of the value, and further for 95.5%, 99.9%, 92%. You need to memorize these particular values from the Z table available, and further those values are to be memorized, to be crammed by you so that you could use them in the examination itself. And it is not only helpful in the BFM exam itself, it is also helpful in the ABM exam. Okay, so now let us have a look at the another unit which is related to the risk and the banking business. So kindly please wait for a minute so that I could change the file over here. Okay, so it is related to the risk and the banking business, risk and banking business. So as we see, banks are indulged in different dimensions. Banks are working in different dimensions and different areas, and further different banking lines are there and different diversity is there. So business lines vary from the commercial banking, corporate finance, retail banking is there, trading and investment banking is there, foreign exchange is there. So within each line of business, there are subgroups and sublines. So if we are having multiple products over here, if we are having the multiple products, like we are basically having the retail banking, corporate banking, commercial banking, we are having the investment portfolios, we are having the trading portfolios. So banks offer the services as standalone services also, and also by the grouping of the services. It may be the case in some cases. It may be the case in some cases you are basically getting the value. You're basically getting the value over there for you're getting the value over there. You're basically having you're providing the services to some particular service as a single service, and also providing the services as a group of services. Is that clear? So these products may differ from the customer to customer based needs. So depending upon the customer needs, these services may differ. The key driver in managing all the business lines are enhancing risk adjusted expected return, that is RAROC, that is risk adjusted return on capital you are looking at, so as to get the most out of the business lines. So banking business lines may be grouped broadly under the following major heads, that is a banking book, trading portfolio, of balance sheet exposures. So first of all, we will be looking at the banking book itself. So the banking book includes what? It includes all the advances, it includes all the deposits and borrowings. So whatsoever amounts you have advanced, that you have lent out, and further whatsoever deposits you have basically with you, maintained with you, whatsoever borrowings you have done so far, so those all will be covered under the case of the banking book. And further, usually these arise from the commercial and retail banking operations. So all the assets and liabilities of the banking have been following characteristics. What characteristics those are having? First of all the assets and liabilities in the banking books are said to be held till maturity. It is taken as that whatsoever the assets and liabilities you are having, those will be held till maturity. Those will be held till maturity, that you will not be having any of the prepayment or any of the advance payments in that particular regard. All the assets and the liabilities would be held till maturity. That is considered, that is basically taken as the characteristics of this. And further, maturity mismatch between the assets and liabilities result in excess or shortage of the liquidity. Now we have covered the ALM part also. So now what is ALM? This is related to the asset liability management. This is related to asset liability management. So let us take the case for the different for the same time horizon. So let us take the case for the 1 month period, that you are having the assets equal to 200 and you are having the liabilities equal to 210. You're having the liabilities equal to 210. So there is a gap between these two. So there is a gap between these two, that is said to be the mismatch. That is said to be the maturity mismatch. That is for the 1 month horizon. You are having the different maturities under this particular time horizon. For the assets and liabilities, you are having a mismatch in between. Okay, so this is commonly known as what? This is related to the liquidity risk, because if there is shortfall, if there is basically shortage related to the liquidity, in that particular case you must be borrowing from the market itself so as to cover the differences between these two. Okay, so that is basically related to what? That is related to the liquidity risk. And interest rates on the assets as well as liabilities change on their maturity. As we already discussed, that whatsoever the assets and liabilities are there in the case of the bank book, those are basically held till maturity. So interest rates on the assets and liabilities so held in the banking book, the interest on those assets liabilities is going to be changed on their maturity, and whenever the interest is going to be changed, that is going to impact what? That is going to impact the net interest margin. And if there is a adverse movement, so if the net interest income to you is reduced, in that particular case it will amount to what? It will amount to the interest rate risk. Okay, and further it is related to the asset side of the banking books generate the credit risk. So assets are related to what? So whatsoever investments you have done, those are not covered under the banking book, those are covered under the trading book. In the case of the banking book, we are considering the asset part to be the lending part only. So whatsoever the credits you have done so far, those will be covered under the asset side. And further, the asset side is associated with the credit risk, that is a default risk. So it may be the case that there is a default on the part of the borrower, so as for the repayment of the loan. So that is basically amounts to what? That amounts to the default risk or the credit risk. Then it is related to operational risk. So loss of possibility may arise from the human failures, from the omission or the commission or a deficiency in the information system or the system failures, inadequacy or non-adherence of the internal processes, external events may be there. These are all related to the operational risk. So what I meant to say, that in the case of the banking book, there is liquidity risk, there is interest rate risk, there is default risk or the credit risk, and further there is operational risk. Okay, and accrual system of accounting is used in the case of the banking book. Now what is accrual system of accounting? So whatsoever amount is due, whatsoever amount of interest or your income is due, you consider it as your profit. Okay, so let us take the case that on 31st of March the interests were charged on all the loan accounts. The interest was charged. Now the customers have not paid the interest amount to the bank so far. The interest amount which is charged in these accounts has not been paid so far, but still the bank will be considering the interest so charged in their income. The bank will be considering the interest so charged in their income, because this particular part is due to the bank. Bank is basically the rightful owner to receive this particular interest, yet it is not paid. That is another system, but the bank will be considering the income in this particular case, because the system used in the banking system, it is the accrual system of accounting. Okay, now let us consider related to the trading book. So the trading book includes all the assets that are marketable, that can be traded in the market, Okay, so they are normally not held till maturity. In the case of the banking book, whatsoever the assets and liabilities we considered, we said that those all assets and liabilities would be held till maturity. Okay, but in the case of the trading book, we basically consider all the assets that are tradable, those are marketable. Okay, so in that particular case, these assets are not generally held till maturity, and positions are liquidated in the market after holding it for a specific period. So let us take the case that the bank has invested in the capital market. In that particular case, the bank will be holding the investments, and further after some particular time period, after holding it for some particular time period, the bank will be liquidating these securities. Okay, so these are basically held with the principle of marked to market basis. Like, what is marked to market basis? So let us take the case that we purchase a scrip So the shares, we say technically these are scrips that we purchase. So we purchased a scrip for rupees 10, and further the other day the price of the market price of the scrip is 12 rupees. So it will be considered, it will be having a value of 12 rupees in the trading book itself. On the next day the value dropped to 9 rupees. It dropped to 9 rupees. On the third day we will be considering this particular value in our trading book. That is said to be the marked to market system. So mark to market system is followed, and the difference between the market price and the book value is taken to the profit and loss account. So in the first scenario, when the previous day the price was 10 rupees and on the next day the price was 2 rupees, you will be booking rupees 2 as profit, and further on the next day when the price dropped to rupees 9, you will be booking minus 3 as your loss. Okay, so that is how this system works, that is mark to market system works. So trading book mostly comprises of the fixed income securities, equities, foreign exchange holdings, commodities. Okay, those are all covered under the trading book. And further, derivatives are held for for trading in the market, and over the counter trade are also considered under the trading book. Those are also considered under the trading book. So derivatives are those whose values are derived from the underlying assets. Okay, so in those cases the derivatives are of two types. One, it is the exchange traded derivatives, and the other one, it is the over the counter derivatives. Over the counter derivatives, so whatsoever derivatives are there which you are holding for trading purposes, which you are holding for the trading purposes, and further it may be the case that you are holding them for hedging the exposures, so as to safeguard yourself. You are holding the derivatives. In both the cases, those would be considered under the trading book itself. Okay, then further, trading book is subject to adverse movement of the market prices. It is basically, the trading book is subject to the adverse movement of the market prices until they are liquidated. So whensoever you are holding the securities, you are holding the basically assets over there, it may always be considered there may be a adverse movement in the market, and that may impact your portfolio itself. And further, this is termed as what? It is termed as a market risk. And trading book may have market overseas. It may be the case that we are having the market overseas. Instruments having the lower demand have lower trading volume and are exposed to the liquidation risk, and that is said to be the market liquidation risk. So let us take the case that you are having a huge quantity of the shares that you purchased. Huge quantity of shares were purchased by you, and further the market price of share is 12 rupees. Market price of the share is 12 rupees, but you are unable to sell these particular shares at the market price. You're not able to sell these shares at the market price. Though the market price is 12 rupees, still you're not able to liquidate this particular security. In that particular case, it amounts to what? It amounts to the liquidity risk. And the trading book is also exposed to the credit risk or default risk, which arises due to the failure of the part of the counterparty to keep its commitment. It may be the case that you have basically procured the securities, but when you went to liquidate the security, you were unable to do so due to the failure of the counterparty. So the credit risk is there in the case of trading book too. Then it is a case operational risk also involved in the case of the trading book. So in the case of the trading book, the risks involved are related to the market risk, liquidation risk, credit risk or default risk, and fourth, it is a operational risk. Okay, fourth, it is a operational risk. Whereas in the case of the banking book, the risk involved were interest rate risk, liquidity risk, default risk or credit risk, and further the operational risk. Then it is a case of the off balance sheet exposure. What are off balance sheet exposures? So these liabilities are contingent in nature. That in the case of the bank guarantee, when let us take the bank guarantee is extended by the bank, in that particular case there is no direct outlay of the fund. That is, the amount is not disbursed yet. Let us take the case that the bank guarantees have been issued on the behalf of person A in the name of person B, that is B is the beneficiary over here. In that particular case, there is a contract between these two, and further if the obligation was not performed by the person A over here, for which the bank guarantee was extended, in that particular case the bank has to comply with the commitment and further has to pay the amount. So in the case of bank guarantee, There is no direct outlay of the fund, but it may be the case that in the future the liability may crystallize. The liability may crystallize. So basically these contingencies adversely affect the revenue generation of the bank. These basically adversely affect the revenue generation of the bank. So because there is a liability over there, that is a contingent liability, not yet crystallized, but it may be the case now that it will be crystallizing in the near future. In that case, it adversely affect the revenue generation of the bank. So banks may also have the contingency receivables. It may be the case that banks are having the receivables which are contingent. It may be the case that they will be receiving the value, or it may be the case that they will not be able to receive the values. Okay, so derivatives are off balance sheet market exposures. They may be swaps, futures, forward contracts. So whatsoever derivatives you are holding, for trading purposes or for hedging your exposures, those are basically what? Those are related to the trading book. But when derivatives are there for the when the derivatives are held till maturity, those would be considered the part of the off balance sheet exposures. So these may be swaps, futures, forward contracts, foreign currency contracts over their options, etc. Okay, and for the contingent exposure may become a fund based exposure. So when the amount is to be paid to the beneficiary over here, in that particular case a non-fund facility, this was a non-fund based facility now, that basically converted to the fund based facility. Now there is outlay of the fund. In that particular case, if the contingency crystallized. Okay, so such exposures may become a part of the banking book or trading book. So such exposures which are listed over there in the case of the off balance sheet exposures, they may become a part of the trading book or the banking book, depending upon the nature of the off balance sheet exposure. So whatsoever the off balance sheet exposures you are having, it may be the case that will be becoming the part of the trading book, or it may be the case that may also become the part of the banking book. Okay, so therefore the off balance sheet exposures may have the liquidity risk, interest rate risk, market risk, default risk, and the operational risks. Okay, so what were the difference between the market, what were the basically difference between the trading book and the banking book? That in the case of the banking book we were having the interest rate risk, whereas in the case of the trading book you are having the market risk. Okay, but in the case of the off balance sheet exposure, we may have all the risks that those are described over there in the case of the trading book as well as the banking book scenario. Is that clear? So that is related to it. Now let us have a look at the banking risks and the definitions related to those. Banking risks and definitions related to those. So first of all, we will be covering the different type of risk, whether it is a liquidity risk, interest rate risk, market risk, default or credit risk, and the operational risk. So first of all, have a look at the liquidation risk. So liquidity risk is inability to obtain the funds to meet the cash flow obligation. So let us take the case that bank is under a deal, and further bank has basically taken a deposit of rupees 1 crore from the depositors and lent rupees 90 lakh out of it, and the amount has been lent for a period of 5 years, and further the deposit is with the bank for a period of 3 years. It is for 3 years. Now after the period of 3 years, let us take the case that the person do not want to renew the FDR, do not want to renew the deposits. In that particular case, the bank is having the obligation so as to refund the money, so as to return the money to the depositor. So in that particular case, the bank will be facing what type of risk? The bank will be having the liquidity risk, because the bank is having the inability to obtain the funds to meet the cash flow obligations at a reasonable rate. It may be the case that the bank will be availing the funds from the market at a higher rate. Okay, so bank is having the inability so as to meet up the obligation, so as to meet up the cash flow obligations at a reasonable rate. Okay, so that is related to the liquidation risk. So liquidity risk of the bank arises mainly from the funding of the long-term assets by the short-term liabilities. Now in this particular case, the 90 lakh which have been lent, these are the assets, and these are basically lent for the long term, whereas the deposits are the liabilities. So that is a point which is cleared over here, that mainly from the funding of long-term assets by the short-term liabilities, that is the main reason related to the liquidity risk. Then it is related to the types of liquidity risk. So first of all, it is related to the funding risk. So first of all, it is related to the funding risk. So risk arises from the need to replace the net outflows due to unanticipated withdrawal or non-renewal of the deposit. The same case we considered above, the same example we have taken over here, it is the specifically related to what type of liquidity risk? It is the funding risk. When we are unable to fund the obligations. Okay, so that is basically related to what? That is related to the funding risk. And then it is a time risk. Then it is related to time risk. This risk arises from the need to compensate of non-receipt of expected cash flow. So it may be the case that if there is a default, the amount you have lent, let us take the same example, that you have lent rupees 90 lakh from the deposits of rupees 1 crore. Okay, now in this particular case, there was an obligation on the borrowers that they will be repaying the amount, but the borrowers never repaid the amount, or the partial repayment was there. In that particular case, the bank will be unable to meet the obligations. The bank will be unable to meet the liquidity obligations because there is default in the repayment. Because the performing assets were converted into the non-performing assets. That is basically related to what? That is related to the time risk. That is related to what type of liquidity risk? That is related to the time risk. Then it is related to call risk. So call risk arises due to the crystallization of the contingent liabilities. It basically arises due to the crystallization of the contingent liabilities, like as we are having the letter of credit, bank guarantee, co-acceptances. All these are examples of the contingent liabilities. And this may also arise when a bank may not be able to undertake the profitable business opportunities when it arises. So what does it mean? It may be the case that the bank has given a bank guarantee. The bank has extended a bank guarantee, and further the event occurred over there, and the bank is now to compensate. Now the contingencies crystallized in this particular case. Now the contingencies was what? That in the worst scenario, if the person on whose behalf the guarantee has been extended will not be able to fulfill its obligation, then the bank has to compensate. Okay, so now that event occurred. Now the bank has to compensate the beneficiary over there, and further there will be outlay of the funds. That we say it as the crystallization of the contingent liability, and that adversely impact the bank's profits, because ultimately, let us take the case the guarantee was given for an amount of 1 crore. Now the bank has to pay that particular amount, and further it may be the case that the bank is not ready to pay that particular amount. So bank has to maintain the deposit by borrowing from the market at a higher price. Okay, so that is related to what? That is related to the call risk. Okay, then it is related to the interest rate risk. So interest rate risk is the exposure of a bank's revenue to adverse movement in interest rate. So it may be the case that the bank is maintaining the different assets and liabilities. Bank is basically maintaining different asset and liabilities. Now what if the interest rates changed? It may be favorable that bank is now earning more, but these may also be unfavorable. Let us take the case of the assets. In the case of the assets, if the interest rate dropped, but on the liabilities you are paying a fixed rate of the interest. Let us take the case in the case of the liabilities, that in the case of the deposits you are paying a fixed rate of interest, but in the case of assets there is a floating interest rate. And let us take the case that you have lent the amount at 9%, and further you are paying on liabilities at 5%, but now it was floating. Now it is repriced to 8% after a particular time period, after a particular frequency. Now it is repriced. Now you are basically receiving 8% from the borrowers, whereas you are paying the same interest to the depositors over here. So over here the net interest income was 4%, whereas in this particular case now the income is dropped to 3%. So that is a riskier now. So that is a risk imposed on the bank itself. So it is related to what? It is related to the interest rate risk. So it impacts the earning aspect of the bank, and also the economic value of the bank's assets and liability, and the off balance sheet position is changed due to this particular type of risk. So let us consider the different type of the interest rate risk. Now first of all, it is related to what? It is related to the gap risk or mismatch risk. So I have already told you related at the it may be the case that the banks are having the different level of the different amounts of the assets and liabilities which are maturing over a particular time horizon. Let us take the case where the assets and liabilities having the 30-day residual maturities, and under the 30 days segment, under the 30-day bucket, we are having the assets which are maturing are equal to 200, and further the liabilities which are maturing are amounting to 250 for this particular 30-day bucket. For this particular 30-day bucket, in that particular case, you're paying the amount on the assets, and further you are also paying the amount on liabilities, and further these assets are not matched with liabilities. These assets are not matched with the liabilities, so you are holding different amount of assets and liabilities or the off-balance sheet exposures with the different principal amount. It may be the case that there are different maturity dates or the repricing date, and in that particular case, that will be creating an exposure related to the unexpected change of the interest rate. So in that particular case, if the interest rates changed, that particular case, if the interest rates change and there is a gap in between, that will seriously impact your earnings. That will seriously impact your earnings. So that is related to that. Now let us understand it with an example. Now let us understand it with a practical example. So it says an asset maturing in 2 years at a fixed rate of interest have been funded by a liability maturing in 6 months. Okay, so we are having a liability which is maturing in 6 months, and further an asset has been financed by this liability which is maturing in 2 years, Okay, so that is a case related to it. And further, or a liability maturing over a period but getting repriced periodically, or liability maturing over a period. So, or we can take a case that the liability is also maturing, in 2 years, but it is repriced at a 6-month period. It is repriced at a 6-month period. What does it mean? It means that the interest rate that is to be paid on the liability, it will be changed after every 6 months. The interest margin would undergo a change after 6 months of the repricing period, causing the variation in the net interest income. Are you getting my point? Okay, so it may be the case, so there is gap in between. So there is gap in between, the assets and liabilities are deferred, and further moreover there is a repricing, there is changes in the repricing over frequency, or it may be the case that there are changes in the maturity, or it may be the case their principal amounts are different. In that particular case, a difference between the interest rate or the movement of the interest rate can adversely impact the earnings. So that is related to it. Next, it is related to the basis risk. Okay, so the risk that the interest rate of the different assets and liabilities and off balance sheet items may change in different magnitudes is termed as a basis risk. Okay, so the risk that the interest rate of the different assets, liabilities and off balance sheet items may change in different magnitudes. So let us take the case that where the liabilities are having the interest rates based upon the benchmark rate B1, and further the assets are priced as per based upon the benchmark rate B2. Okay, and further let us take the case the repricing frequency is same. The repricing frequency is 6 months in both the cases, that both the assets and liabilities will be repriced after a period of 6 months. Okay, but it may be the case now that the benchmarks do not change in a particular manner. Benchmarks do not change in a particular manner. Let us take the case that the B2, that is a benchmark 2, moved with 40 points, whereas the benchmark 1 moved with the 60 points. So whereas previously, let us take the case, if you were charging 5% on the deposits, and further the borrowers are paying you at 9%, now the changed amount would be that the borrowers are paying you at 9.40%, but you are paying to your depositors at 5.60%. So ultimately your margin is now reduced. Here your margin was 4%, whereas in this particular case you are having margins equal to 3.80%. That is equal to 3.80%. So that is a case related to it. So now your net interest income is now reduced. net interest income is reduced. So that is basically related to what? When your assets, liabilities and off balance sheet items are based upon different basis. It is basically based upon different basis. They may change in different magnitudes. They may change in different magnitudes. That is basically related to what? That is related to the basis risk. Then it is the yield curve risk. Then it is related to the yield curve risk. So now what is yield curve? Now what is yield curve? So it is basically related to what? Like you are earning over a particular asset. Let us take the case in the case of treasury bills. Like this is particularly represents a yield related to one instrument, and further it is a yield related to some other instrument. It is yield related to some other instrument. Okay. So in the case of floating rate interest rate scenario, banks pricing their assets and liabilities based upon different benchmarks. Bank basically price their assets and liabilities based upon different benchmarks. Okay, let us take the case that in the first case, in the case of the assets, you are pricing them at B1, and in the case of liabilities, you are pricing the liabilities based upon the benchmark B2. Okay, and further, in the case banks are using two different instruments maturing at different time horizons for pricing their assets and liabilities. Let us take the case that you are having the two different instruments. You are having the two different instruments which are maturing at different time horizons. Let us take the case for the B1, you are having the 91-day treasury bills, and for the B2 you are having the 364-day treasury bills. In both the cases, the yield is not parallel always. There is non-parallel movements of the yield curve. Okay, so if there is a change in the market scenario, if there is change in the market interest rate, it will not be the case. It will not be the case that both the yield curve will be moving with the same parallel space. So if there is changes, let us take the case that the yield curve in this particular case is changed as per this scenario, and further in the case, this particular case, the yield curve is not that much steep. Yield curve is not that much steep. So there is basically differences between the yield curves when you are using different instruments, so as for pricing your assets and liabilities, and further when there is interest rate movement, the movements in the yield curves could not be the same, could not be the parallel, they could not be parallel, and further there could be non-parallel movement. There could be non-parallel movement which could affect the net interest income. So an example is given over here. That would says when a liability raised at a rate linked to say 91-day treasury bills used to fund an asset. Okay, so when basically what happened actually, that you are having a liability which is based upon 91-day treasury bill, and further this liability is used to fund the asset, which is priced against the 364-day treasury bill. It is priced based upon the 364-day treasury bill, and further it is your asset. Now in a rising interest rate scenario, both. Now if there is a rising interest rate scenario, that the interest rates are not rising up, now there is basically different yield curves for both of these. There will be different yield curves for both of these. So that will be basically amounting to non-parallel movement of the yield curve, and it will impact your net interest income. That is related to the yield curve risk. Then it is related to the embedded option risk. So embedded option is related to what? It may be related to the prepayment of the loan amount. It may be the case of the exercise of the call or put option in the bonds or debentures on the derivatives, or it may be the case related to the premature withdrawal of the term deposit. So that is related with what? That is related to the embedded option risk. Now how it is related to the interest rate risk, let me tell you. Now if there is more variability in the interest rate, in that case the embedded option risk is higher. Let us take this scenario that previously the interest rate was 5.40%, but now it changed to 9%. Now if the interest rate was having a steep change, in that case the depositors will be exercising their embedded option risk. And also if a loan was extended, let us take the case a loan was extended at 12%, And further, now the housing loans are 6.70%. Definitely the borrowers are going to prepay the loan amount. Definitely the borrowers are going to prepay the loan amount. So that is basically related to it. So faster and higher the magnitude of the changes in the interest rate risk, more greater will be the embedded option risk related to it. And further, it affects the net interest income. It impacts the net interest income. Then it is related to the reinvestment risk. It is related to the reinvestment risk. Now what is reinvestment risk? Let us take the case where you have lent the money to person B over here, and he is repaying the amount in monthly installments. He is repaying the amount in monthly installments. So whatsoever the amount is repaid by the person B, it will not be the case that it may be the case that you have, basically let us assume that you have lent the money to person B at 11%. Okay, so it may not be the case that whatsoever amount has been received as by the repayment by person B, you will not be able to reinvest this particular amount at 11% in the market. So there is a risk related to it that you will not be able to reinvest the amount received in the same scenario and under the same interest over there, so as to earn the same income. So that is related to what? That is related to the reinvestment risk. Then it is related to the market risk. Then the next one, it is related to market risk. So market risk is the adverse deviations of the marked to market value of the trading portfolio. So when there is different, when there are market deviations as per the market scenarios, demand and supply, and the other forces in the market, so there is adverse movement of your portfolio mark to market values. That is basically related to what? That is related to the market risk. So this results from the adverse movements of the market prices of the interest rate instruments, equities, commodities, currencies, and market risk is also referred to be as the price risk. So price risk occurs when the assets are sold before their maturities. When the assets are sold before their maturities, there comes into picture the market risk. That is why in the case of the trading book, the market risk exists, whereas in the case of the banking book, the interest rate risk existed over there. Then the types of market risk. So first of all, it is related to the forex risk, that is the foreign exchange risk. So forex risk is termed as exchange risk also. It is a risk associated with the movement of the exchange rates. So it is related to the adverse movement of the exchange rates during which we are having the open position. So if you have basically bought the foreign exchange, let us take the case that you have bought USD 10,000. Now you are exposed to the forex risk. Why you are exposed to forex risk? Because there is fluctuation in the foreign exchange prices of the USD. There are fluctuations in the exchange prices of the USD. So whenever you are having an open position, that you are under a transaction, then you are exposed to the forex risk over there. Then it is a market liquidity risk. Now that is the risk that we have already discussed so far. So it is related to market liquidity risk arises when the bank is unable to conclude a large transaction of a particular instrument near to the current market price. So let us take the case that you are having 1 lakh units of the securities. Let us take the case you are having 1 lakh units of the securities, and further in this particular case, let us consider that the market current price is equal to 12 rupees as we discussed in the previous case. But now you are not able to liquidate at the current market price in the market itself. You are not able to sell these securities at rupees 12. Even though the market price is equal to 12, you are not able to sell these securities in the market itself. The market is not having the demand related to it, and you are able to sell these securities at a price of 8 rupees. So that is basically related to it, because your earnings are adversely impacted. Even though the market current price was equal to 12 rupees, you are not able to conclude that particular transaction over there. That is due to what? That is due to the market liquidity risk. Okay. So that would be related to this particular video itself, and further the later part we will be covering in our next videos. So we were basically left with only these three. So we will be completing this unit itself. Okay, so the next it is related to the default or credit risk. Next it is related to the default or credit risk. So credit risk arises when there is a default at the part of the counterparty. When there is a default at the part of the counterparty, that the counterparty fails to meet its obligations. So let us take the case that you have advanced, being a bank, you have advanced an amount to person B over here, and person B basically defaulted in the repayments, So there was an obligation on the person B so as to repay the amount, but the person B was not able to perform his obligation as per the agreed terms. So that is basically related to what? That is related to the default or credit risk. So let us take a note related to the categories of the default risk or the types of the default risk. So first of all, it is related to the counterparty risk. So this is related to non-performance of the trading partners. It is related to non-performance of the trading partners. Let us take the case that you were under a forward contract. Person A is under a forward contract with person B so as to buy the 2000 USDs after a period of 1 month. 2000 USDs after a period of 1 month. That is, B will be selling the USDs to person A over here. Okay, so there was contract, but in between the person B defaulted. Person B cancelled the contract over here, or basically never settled up the commitment over there. So that is related to what? That is related to the counterparty risk, and also it is related to the country risk. Okay, so when the different trade partners are basically, they want to fulfill their obligations, but they are unable to do so because of the restrictions or constraints imposed by the country. So it may be the case that an importer is there and further exporter is there, and importer has made the advanced payment. Because in between the country laws changed, and the exporter is now unable to make the shipment. Due to the conditions and constraints imposed by the country itself, and further these are out of control of the exporter and importer. So these would be also categorized as the default or credit risk. But here the reason for the non-performance is not due to the basically they do want to perform, but these are external reasons. Okay. Then it is related to the operational risk. So operational risk is the risk of loss resulting from inadequate or failed internal processes. So when there are inadequate processes or failed internal processes, or it may be due to the people or due to the frauds, or it may be related to the external events also, those all are covered under the operational risks. First of all, it is related to the transaction risk. So transaction risk is a risk arising from the fraud, whether it is internal fraud or it is external fraud, or it may be that the business processes are failed. Okay, or it may be the case that the inability to maintain the business continuity or to manage the information. So that is related to the transaction risk. So all the frauds are covered, business processes failures are covered, inability to maintain the business and manage the information, all these are covered under the transactional risk. And further, it is related to compliance risk. So compliance risk is what? Compliance risk is of legal and regulatory sanction, financial loss or a reputation loss. It is related to legal and regulatory sanctions. So whatsoever rules have been prescribed by the regulator, and further whatsoever the country rules are there, if you are not complying with those, you may have financial loss in the forms of penalties, you may have the reputation loss also. So this is due to the compliance risk itself. So bank may suffer this type of risks if it fails to comply with the applicable law. So whatsoever the laws of land are applicable, or regulations are there, or code of conducts are there, and standards are to be maintained, if the bank is not complying with the same, the bank may face the compliance risk, and it may amount to the financial loss and also to the reputation loss. Then it is related to the strategic risk. Then the other risks are covering the strategic risk.
So strategic risk is a risk arising from the adverse business decision. So when you are basically not implementing your decisions properly, and further there are adverse business decisions, in that particular case, you face the strategic risk. When you are lacking in responsiveness to the market scenarios or industry changes, you face these types of strategy risk. And further, it is related to the reputation risk. So reputation is a risk arising from the negative public opinion, and it may cause the institution to the litigation and further to the financial loss, or bank may also lose their customer base if the this particular risk is imposed. Okay, so that is related to all these types of the risks over there. So we covered the liquidity risk, we covered the interest rate risk, market risk, credit risk or default risk, and further we covered the operational risk and the counterparty risk, etc. All the risks were covered. So that would be all related to this particular video. I hope that you must have learned the concepts.
So I hope that you must have liked the content of the video. So if you have liked the content of the videos, do give it a thumbs up, and further do share the video among your friends and colleagues who have been preparing for Caiib, and do not basically miss the course which is actually available. It's actually a pro course and you need not to go through anything else other than this particular course over there. So do hurry up and enroll in the course right now and start preparing for the same.